If you want to understand where the small business economy is heading, start by following the credit, because businesses in AI-driven industries are pulling ahead and the gap is widening. Welcome to the Commercial Pulse update for April 7th, 2026. The Experian Commercial Pulse is a bi-weekly report offering a snapshot of the US economy and its impact on small businesses. If you end up liking this video, remember to hit subscribe to continue seeing Experian updates like this in your feed. The US unemployment rate came in at 4.3% in March, down slightly from February, while wage growth continues, though at a moderating pace. In February, prior to the conflict in the Middle East, inflation held steady at 2.4%, signaling relative stability in consumer prices. We do expect March inflation to be higher due to the rise in fuel costs. Small business optimism registered 98.8 in February, down slightly from January, pointing to some softening in business sentiment. Consumer sentiment declined to 53.3 in March, down from 56.6 in February, and 6.5% lower than a year ago, highlighting continued caution on the demand side. At the same time, the labour market showed resilience with 178,000 jobs added in March, rebounding from February's decline and marking the strongest gain since late 2024. And on the manufacturing front, the ISM manufacturing PMI rose modestly to 52.7 in March, its highest point since August 2022, indicating factory activity is expanding. Any reading above 50 indicates growth, so that's a constructive data point. The net effect, a stable but increasingly bifurcated environment where headline strength masks underlying softness. Artificial intelligence has moved with remarkable speed from an emerging technology to a core business capability. AI adoption has outpaced the early growth curves of both smartphones and tablets. Within just 1 year of its introduction, generative AI had nearly 10 times the users that tablets had at the same point in their life cycle. By February of 2026, monthly visits to Claude alone surpassed 290 million, roughly 4 times the number from just 1 year ago. In fact, 78% of organizations report that their AI initiatives are meeting or exceeding expectations in terms of revenue growth and operational efficiency. Looking ahead, 90% of business leaders expect AI to have a significant or transformative impact on their business models over the next 2 years. Now, not everyone shares equal enthusiasm. A June 2025 Pew Research survey found that half of Americans are more concerned than excited about the growing role of AI in daily life. Awareness is high. 47% said that they have heard a lot about AI, but comfort is still developing, and that tension between adoption and apprehension is part of the story. However, adoption has not been uniform, and neither has impact. Our data science team took a closer look, focusing on 3 industries we're calling high-impact sectors, industries where AI is expected to have the most significant and measurable effects on business operations and strategy. Those 3 industries are information, which includes media, telecommunications, and data services, finance and insurance, and professional, scientific, and technical services. What's particularly interesting is how this shows up in credit data. Businesses in high-impact AI industries are seeking commercial credit at a significantly higher rate than their counterparts in other industries. As of January 2026, that gap stood at over 25% more average credit inquiries per business. And this gap has been widening over the past 2 years as AI adoption has accelerated. These businesses are also holding more commercial credit accounts. In January 2023, businesses in other industries actually had 0.52% fewer commercial trades than high-impact industries, about 0.5% fewer. 3 years later, high-impact industries have 3.5% more commercial trades on average, and that gap is continuing to widen. Credit limits tell a similar story. 3 years ago, the difference in average credit limits between high-impact and other industries was about 3%. By January 2026, businesses in high-impact AI sectors were receiving 15.8% more credit on average. And that's a meaningful increase in lender confidence and credit appetite directed toward these sectors. Here's what makes this data particularly interesting from a credit risk perspective. Despite receiving more credit, businesses in high-impact AI industries are carrying lower balances and maintaining lower utilization rates. The gap in average commercial credit card balances between high-impact and other industries peaked at 33% in August of 2023. But by January of 2026, that gap had narrowed to 15%. But high-impact industries still carry lower balances. That combination signals disciplined credit management, leveraging capital efficiency without overextending. Even more notable, credit performance remains comparable across industries with similar delinquency rates and risk scores. In other words, increased AI adoption is correlating with higher credit usage, but not higher credit risk. And there's a lot more on our study of AI and high-impact industries in this week's report, so be sure to subscribe. To learn more, visit our Commercial Insights Hub for deeper analysis on small business trends, and subscribe to our YouTube channel for the latest updates. Reach out to your Experian team to start a conversation. Last, remember to keep informed to stay ahead, and we'll catch you on the next one.